One of the biggest challenges right now is determining just how high the Federal Reserve is going to go on the interest rate. There's a lot of talk between a soft landing and a hard landing. They're also talking about if we are potentially in a recession right now. So there is a lot of debate between the bulls and the bears as to where our economy sits. And I think that's exactly what the market is showing you, with a couple days of strength followed by a couple days of weakness. So in this video, we're going to be talking about the difference between a soft landing and a hard landing. We'll also be discussing all of the cases to show that interest rates will be going higher for longer. And we'll also do the flip side by covering why they could be going lower as quickly as next year. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. We do a new video every single Sunday, so come back and check that out, especially if you like this type of content. And we will get started right into the video. Now, there's all of this terminology between soft landing, hard landing. And if you're not familiar with what that is, we'll go to the essence of that definition. So we'll start off by looking at what is a soft landing. A soft landing in economics is a cyclical slowdown in economic growth that avoids a recession. Now, it's the goal of the central bank when it seeks to raise the interest rates just enough to stop the economy from overheating and experiencing high inflation without causing a severe slowdown. So this is kind of what the Federal Reserve is hoping to do right now. We have Jerome Powell, who is coming out with aggressive rate hikes. We saw a 75 basis point move higher in the last FOMC meeting, which happened this month. And that is the biggest rate hike since 1994. So we are definitely raising in a super high pace, because our inflation is super high. We haven't seen this type of inflation in 30 or 40 years. So they need to raise this interest rate to prevent any further destruction on the inflation front. So they're hoping that with raising the interest rate, the economy on the back end is strong enough to avoid an economic collapse. Now let's bring into play the hard landing. So the hard landing definition refers to a marked economic slowdown or downturn following a period of rapid growth. And it comes from aviation, where it refers to a kind of high-speed landing, while not an actual crash, is a source of stress as well as potential damage and injury. The metaphor is used for high-flying economies that run into a sudden, sharp check on their growth, such as monetary policy intervention that is meant to curb inflation. And there's a lot of people right now that are thinking we are heading into the latter part of this definition, is that economies that experience a hard landing often slip into a stagnant period or even a recession. So when we look at the data that just came out for Q1, we see that the economy has slipped into a negative GDP. Now, for it to technically be in a recession, it needs 2 quarters of negative growth. We're not there yet, but remember, the markets are always forward-looking. So they're always looking 12 months out to kind of predict what is coming down the line. So a lot of people right now are thinking that this hard portion is going to push the Federal Reserve to stop raising the rates. And we're actually predicting, and we'll start to see in some stats, that the analysts and the economists are thinking that the rates will actually come down in 2023. So let's break that down further. And when we talk about a case for rates going higher, well, the straight up fact is that this is what the Federal Reserve is saying. They're saying that they need to increase this rate in order to curb inflation. So if we take what they're saying at face value, we almost have to say there is no doubt that this rate is definitely going to go higher in the short run. And just how high it's going to go is obviously one of the biggest things that everybody wants to know. But we'll take a look at one of the Federal Reserve presidents and what she had to say about the current situation. So Loretta Mester said she wants to see the benchmark lending rate reach 3 to 3.5% this year and a little above 4% next year. And this is to rein in price pressures, even if that tips the economy into a recession. So right now, one of the Federal Reserve presidents is saying the inflation is so bad that we need to raise the interest rates in order to create our own way to cool the economy. So consumers are experiencing this very high inflation that's clouding their confidence in the economy. We're in a path right now to bring our best interest rates up to more normal levels and even restrictive levels so that we can get the inflation rate down and sustain a good economy going forward. Job one now is getting inflation under control. So again, what we were talking about is that the Federal Reserve has no concern right now about the economy. The number one and only goal is to make sure that inflation comes back down to a neutral range, which is like 2 to 3%. And we're sitting at 7, 8, potentially 9%. Who knows where this number is going to go? All we know is that it's potentially in an uptrend. Okay, so we have that basis right now that the Federal Reserve is going higher regardless of what the economy does. And besides that point, we also have a tweet that I came across in the past couple weeks that says once inflation goes above 5%, it has never come back down until the Fed funds rate exceeds the CPI. Now, what does this mean? It means that the interest rates need to go higher than the inflation rate in order to cool down the economy. So if we take a look at this graph here, we can get an indication of what the CPI and what the Fed funds rate has been all the way back to the 1960s. And you can see a very similar pattern here. We can go and take a look high level of that stagnation period where we had high inflation rates, a slowing economy back in the 1970s to the 80s. And we see that the Fed funds rate had to follow what the inflation rate does in order to bring it back down. And it actually stayed higher through the 80s period just to keep that inflation rate down. So the CPIs are in the blue and the red, and the Fed funds rate, or the interest rate to make it simple, is in the green. So if we take a look at that closer end of where we're at today, we see those two CPI numbers absolutely spiking, and we haven't even really started to raise our Fed funds rate. We're at just over 1%, and we have inflation at 8%. So based on this sentiment alone, you could expect that interest rates are going higher, and if we do continue to see elevated CPI, the consumer price index, continuing to raise, then we could see this interest rate maybe even going to 4, 5, 6, 7% just to catch up with what that inflation rate is. So those 2 points alone, what the Federal Reserve is saying out of their mouth, and also what we've seen throughout history, is that interest rates, regardless of the economy, could continue to go higher. But to get a better understanding of where we sit today, the best way is to get the other side of the story. So now we're going to build a case as to why the interest rates could be potentially going lower than what had originally been anticipated. So we're going to start off by taking a look at what Jerome Powell had said recently, in the sense that he's starting to admit that a soft landing may not be as possible as it seeks to tame inflation. Moreover, signals of a hard landing are coming in from the falls of oil and copper prices, as well as the New York Fed's model here, pointing out that there is an 80% chance of a hard landing. Now, remember, we covered the hard landing before. Means that what they're doing is trying to create a recession, actually leads to more damage or a potentially stagnant economy in the long run. This is what the Fed funds rate is predicting over a long run. So we see 20, 21, 22, we see all the years and where that potential Fed fund rates could go. And it was originally implied that this would go up to 3 or 4%. That was common knowledge. But now we're starting to see that they're pricing in an easing in the first half of 2023. So we start to see that path of implied futures, the dotted bright lines, start to come downwards as early as next year. And we can actually see the same type of pricing that's happening from the market. So I found another chart here online which shows what the future fund rates will be, and they actually show it, as much as it was above 4%, which we can see the blue line hit, which was the March futures. They are actually all on a downtrend. So a similar type of chart, just the markets and the analysts are pricing in that the economy won't be able to handle these high rates, and the Federal Reserve will have to pivot from their original plan of raising the rates higher to tame inflation, in the sense that they are doing it right now by raising the interest rates alone. So these two charts are showing that the markets are pricing in the fact that the rates won't be able to stay high without killing the economy. And it's interesting to see, especially since there was so much understanding that, the economy would be able to handle it. That's what Jerome said, unemployment rates he had talked about. So that was interesting. We also have a chart which we'll pull up here, which is the Atlanta Fed. So another one of the presidents or divisions, which is estimating that the economy is going to go into a recession. And that's the last thing that the Federal Reserve wants. So in order to prevent the recession from happening, they will have to lower the interest rate. So that's just a little bit of what is going on in terms of that perspective. And the next thing that we're going to take a look at is the Fed's dot plot. So we've covered this before on previous videos a long time ago, but this is what the Federal Reserve presidents are predicting in terms of years and where the potential interest rate will be. So on the axis, we have the percentage of the Fed funds rate, and then the years on the bottom. So the Fed's dot plot that recently came out in the June 15th meeting is actually showing themselves that the interest rates will be on a downward trend. Now, this is just estimates and analyzation of what's going on, but it is interesting to see so much statistics coming out now that the interest rates will actually be on a downtrend. Meanwhile, we haven't really seen a true picture of CPI coming down or the inflation rate coming down. So those are some of the bullish reasons as to why the interest rate could be going lower. And as the interest rate goes lower, it allows us for our economy to expand a little bit and be able to make money a little bit cheaper. But yeah, those are the two plays that are going on right now. But I wanted to get your thoughts as to what you think is going to happen in the future. Are the rates going to continue to go higher, or are the rates on the downturn in 2023? Let me know down below what you are thinking. Obviously, right now, there's just so much different data sets which are pointing in different directions. For me, I'm not entirely sure as to where we go. I definitely do see us going higher. It just all depends on what that inflation rate is doing. So yeah, let me know your thoughts down below. If you're still here with me, make sure to like the video. I definitely appreciate all of your support. Every single Sunday, we come out with new videos, so make sure to hit that subscribe button, turn that notification bell on. I hope you all have a great week in the markets. Happy trading.